Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on the consolidated statement of financial position by learning how to deal with intra-group adjustments. Okay, now I want you to take your time and listen very carefully because intra-group adjustment is one of the key things that worries a lot of people. Now, what you need to understand is that in the consolidated statement of financial position or in group accounts, we need to understand the single entity concept. Okay? We need to understand the fact that even though the parent and subsidiary are two separate entities, when we are consolidating the accounts, we have to view them or see them as a single entity. And once they are seen as a single entity, it means that intra-group balances should be cancelled out. In other words, there are lots of intra-group adjustments that I'm going to talk about. But what I'm trying to say is that, for example, one company cannot sell goods to another company in the same group at a profit. We don't accept that. Okay? So we need to view the group as a single entity when preparing the consolidated statement of financial position. And by doing so, we eliminate intra-group balances. Now, what are the intra-group balances we are going to talk about and how are we going to eliminate them? Let me quickly narrow your mind to them. Now, we are going to talk about, first of all, we are going to talk about intra-group balances. And then we are going to talk about fair value adjustment in this video. Even though the main focus is on intra-group adjustment, we are going to talk about intra-group balances and then fair value adjustment. Now, when we talk about intra-group balance adjustment, there are four basic things that we are going to talk about. I'm going to talk about intra-group loans, debentures, and redeemable preference shares. I'm going to talk about that, okay? This is one of the intra-group balances we're going to deal with. And then we're also going to deal with intra-group trading, where there is a trading between the two or two or more, the group, or let's say a parent and a subsidiary or a subsidiary and a company is into trading. We are going to deal with that. Now, with the intra-group trading, I want to take my time to split and explain them for you. And so, first of all, I'm going to deal with intra-group trading that has resulted in receivables and payables. So, debts, intra-group trading, which has resulted in debts, whereby one company owes another company. I've told you we are going to look at the business as a single entity. And as a single entity, you cannot owe yourself. And so if parent company owes the subsidiary or the subsidiary owes the parent, that must be cancelled out. And maybe most of the time, those happens because of intra-group trading. And so we are going to deal with intra-group trading debts. And then also, we are also going to deal with another area of intra-group trading, which is unrealized profit. So unrealized profits. We are going to look at how to eliminate unrealized profit as well from the group. And then also, finally, we are going to deal with the transfer of non-current assets. The transfer of non-current assets from either parent to subsidiary or subsidiary to parent, which can also result in unrealized profits. Now, these are the intra-group adjustments we are going to deal with. Actually, the fair value adjustment is not really an intra-group thing, but then I'm going to add it to this so that when I'm done with it, I know that I am done with every adjustment related to the consolidated statement of financial position. Then we can move on to the consolidated statement of profit or loss, after which we are going to talk about accounting for associates and investments in joint ventures. So we can conclude on the basic consolidation principles. All right. So these are what we are going to talk about. So fair value adjustment will be the last one because it's quite different from the intra-group adjustment. Now, the main focus is on intra-group adjustment, and we are going to talk about four main things with intra-group. And I'm going to start with the loans, debentures, and preference shares. And then I'll move on to how to deal with intra-group debts. And then we'll look at how to deal with intra-group unrealized profits. And then finally, the transfer of non-current assets between parent and subsidiary. All right. Okay, so let us begin with the first intra-group adjustment, which is the loans, debentures, and redeemable preference shares. Now, how do we deal with those ones? If you have loans, debentures, and redeemable preference shares, between a parent and a subsidiary, how do you deal with this? If you have loans, debentures, and redeemable preferences. Now, first of all, this is what you have to do. Now, loans and debentures that we are talking about, we are not talking about external loans, external debentures, or external redeemable preferences. We are talking about a situation where either the parent has acquired debentures or has a stake in terms of preference share in a subsidiary, or the subsidiary has in a parent. In other words, one company has invested a debt instrument in another company of the same group. Now, when that happens, when we are consolidating the account, we look at the entity as a single entity. And so we don't expect to see one owing the other and then one having investment in the other. We don't accept that. And so what we have to do is that we cancel them out. Okay, so it could be a parent owing a subsidiary, or a subsidiary owing a parent. It could be a parent having a debt investment in a subsidiary, or a subsidiary investing in debt in a parent. Whatever the case will be, we say we cancel it out. And so the treatment for intra-group loans, intra-group debentures, and intra-group preference shares is that we cancel them out. And how do we cancel them out? Now, normally what you are going to see is that you are going to see that under non-current assets, okay, under the non-current asset of the company that is making the investment, you will see that they have investment in the name of preference shares, okay, as a non-current asset. Let's say 2,000, and then you go to the, if let's say if this is for the parent, you go to the subsidiary under their long-term liability. Okay, they are also going to have redeemable preference shares of the same amount, 2,000. So what we are trying to say is that one company will see it as an asset because they have made investment in the another company. Now, another company is seeing it as a liability, a long-term liability, because they have also gone to borrow from another company. Now, whatever the case will be, they will show them in their individual financial statements. But in the group account, or in the consolidated statement of financial position, we need to, when we are consolidating, this will not appear. It will be cancelled off. And this will also not appear. That is what I mean by cancelling them out. So whether they are loans, whether they are debentures, or they are preference shares, what we are trying to say is that we can only owe outsiders or third parties. We cannot owe ourselves. And we can only invest in third parties. We cannot invest in ourselves. So they can be working, they can be true for when we are preparing individual financial statements. But the moment you want to consolidate the account, you look at the organization as a single entity. And once we are a single entity, intra-group loans, debentures, and redeemable preference shares must be completely cancelled out. One cancels the other so that they leave no effect on the consolidated statement of financial position. That is how to deal with the first one that I spoke about, intra-group debentures, preferences. Now let us talk about intra-group debt as well as a next item, the intra-group debt. Now, when it comes to the intra-group debt, okay, now I made it intra-group trading because I presume that trading leads to debt most of the time. But there are times where it may not be necessarily trading. It could be debt in general, okay? So I'm just going to focus on the debt component. And what I mean by debt is that one company is owing the other company. This time, not in a long term, but in a short term. So we are dealing with working capital issues. And most of the time, it comes up because of trading. So one company, it could be the parent or the subsidiary, buying from the other company on credit. And it's going to create trade receivables in one company and then trade payables in another company. That is what we are trying to say. And so you are preparing a consolidated statement, or you have individual financial statement, parent and subsidiary. And then you see under the current assets, you see trade receivables, maybe from, or trade receivables from company S, 100. And then in the current liabilities, you see trade payables from P. Let's say you see 100. Now, take note of this. The trade receivables and trade payables could be given in a bulk figure, but it's either they separate that which is owing to the subsidiary so that you have general trade receivables and then that which is owing from the S, or S means subsidiary in this case. Or what they are going to do is that they are going to give you all the trade receivables and payables as a go, but in additional information, they will mention that P owes, S owes P 100 cedis or $100, and then P also has to receive that amount from S. Now, whenever this happens, what we are saying is that in the consolidated statement of financial position, P cannot be a creditor of S, and S cannot owe P. So what we do is that we cancel them off. And so when you are doing consolidated statement of financial position, this 100 and that 100 will be canceled out. It will not appear because of the idea of the single entity concept. That is what we mean. Now, it could be from parent to subsidiary, it could be from subsidiary to parent. Now, it could have been the other way around. It could have been the subsidiary rather having the asset and then the parent having the liability. Whatever the case will be, whether from parent to subsidiary, subsidiary to parent, the general rule is that because of the single entity concept, these two must not stand in our consolidated statement of financial position. And so when we are adding across on the consolidated statement of financial position, we are going to subtract this 100 from receivables and we'll subtract this 100 from payables to reflect that both companies are a single entity. All right. That is not all. There are times where you see receivables to be 100, that is receivable from P, and then payables to S will be 80. Now, what we are trying to say is that now S has shown in their books that they have 100 to receive from P. That is, P is owing them $100. Now, in the books of P, they have also shown that they are owing S only 80. So what is accounting for the difference? Please pay attention. When the values are the same, you just cancel them off, like I told you. But when the values are not the same, the reason could be two, and only one may be possible. Now, it's either we are dealing with cash in transit, or we are dealing with goods, that is stock in transit. And remember that each of them will be treated differently, so please pay attention. Now, if 100 cedis is to be received from P according to the books of S, then P is saying that no, we are only owing 80. Now, it could be that they have paid 20, but S is not yet aware. They have transmitted the cash, and the moment they transmitted the cash, whether through electronic or whatever means, they have reduced their balance to 80 because they know they have paid. S is yet to receive that cash. And so because they are yet to receive it, they have not made the change. Okay? So what is going to happen is that this is a case of cash in transit. This is a case of cash in transit. And most often than not, the question will specify for you that it's either cash in transit or goods in transit. It will be specified in the additional information. So please watch out for something like that. So whenever this happens, you will see that S is here to receive the 20 cedis cash, but P has already transmitted it, so they have reduced their liability to 80. So in canceling out, you cannot cancel 80 and 100. I've already told you in a previous video that when we are canceling out, especially in the case when I was teaching you cancellation and part cancellation, I told you that we cannot cancel out figures that are not the same. So the maximum we can cancel out here is the 80. So the 20 will stand in the consolidated statement of financial position. But how are we going to let the 20 stand? The 20 is going to stand as cash in transit. And so this is what it's going to be. When we are preparing the consolidated statement of financial position, we are not going to show this 80. We are also not going to show this 100. But the 20 that is remaining will be shown here. So we are going to have cash equivalent from the parent of the company, subsidiary. So when we are consolidating, when we get to cash, we are going to bring that of the parent's cash plus the subsidiary's cash plus the 20. before we bring the final answer in the consolidated statement of financial position. So in other words, your final cash balance on the consolidated statement of financial position is going to be the parent's cash balance plus the subsidiary's cash balance plus the 20 cash, which is cash in transit. So this 80 will not appear, this 100 will also not appear, but the extra 20 will now be shown as a consolidated cash, as a cash in transit, which will be added to the cash balance to still make the statement of financial position agree. If you do not show this 20 and you are taking off this 100 and this 80, you should know that the assets side is being shortened by 20. But the moment you bring it and add it to your cash, then what it means is that you are actually bringing in the 20 effect, and then your statement of financial position will still balance or agree. So that is how to treat it when it is the case of cash in transit. So this could be cash in transit or it could be goods in transit. So I have just explained the portion where it is cash in transit. Let us look at a situation where it is goods in transit. Now, in that case, what it would have meant is that maybe this subsidiary, initially it was 80-80, but they have sent or they have dispatched goods worth 20 CD to the parent. So the goods are on their way coming to the parent. However, the parents have not yet received the goods. So they have not reflected the change here. So the moment they dispatch 20 CD worth of goods, maybe by vehicle, they have added the 20 to the 80 that, okay, the parent now owes me 100. Meanwhile, the parent has not yet received any goods. So they still maintain that they owe only 80 till the goods are received. Now, in that case, the extra 20 will be treated as goods in transit, not cash in transit. So in that case, still, we are going to cancel out only the 80. But this is what we show. The debt must not appear at all to show that anyone is owing any other. That is, no parent cannot owe subsidiary, subsidiary cannot be owed by parent. So what we are saying is that both the 80 and the 100 will not appear in the consolidated statement of financial position. But the extra 20 will be shown as goods in transit. And this time, because it is not cash, we cannot add it to the cash. Because it is goods, it will be added to inventories. And so when we are consolidating, when we get to the inventories under the current asset, we'll bring the inventory of the parent plus the inventory of the subsidiary plus the 20, which will be the goods or the stock in transit. So that is how to deal with intra-group debts that are not in agreement. Now, if they are in agreement, bingo, it's the simplest you can ever get. You just cancel them off without any goods or cash in transit wahala. But the moment they are not in agreement, then you have to start thinking about either goods in transit or cash in transit. And to be sure, the additional information is going to make that available for you. You should be very mindful of that. If it is not clear as to how you should treat it or what is causing the difference, I think you can use your discretion and use any of them to make it agree. And I think the examiner will bear with you. But I am very confident that you will not be left in a confused state. Definitely the question should clarify what is causing the difference between the intra-group debts. And so, ladies and gentlemen, that is what I meant by intra-group debts, or intra-group trading resulting in debts. Okay, so we sell to each other and then we cancel off our debt. Now, the third and one of the most tricky aspects that I'm going to deal with, still under intra-group trading, is the unrealized profit. And you need to pay attention very well at this place because it's not going to be so juicy, maybe, but I will make sure I try to make it juicy. All right. Okay, so the next thing to talk about is the intra-group unrealized profit. Now, just as I was saying, it's quite technical, so please pay attention. Intra-group trading, that is resulting in unrealized profit. Now, over here, the key term here is unrealized profit. Now, with the intra-group trading, it can result in debt, which we have learned how to cancel out. And it could also result in unrealized profit. Now, take note that when parent sells to subsidiary or subsidiary sells to parent, most of the time, at the time of sale, they are operating as individual entities. So just as any other person will sell at a profit, they could also sell to each other at a profit. Now, the problem is not really about selling to the parent as a profit or selling to the subsidiary as a profit. But the problem arises when the goods that have been sold to the parent or subsidiary remains in stock or remains unsold at the date of consolidation. That is where the challenge comes. Because there is a profit element on the inventories that are not yet realized. And that is what we call unrealized profit. And so if parent sells goods to subsidiary, now here also there are two scenarios. We are going to look at how to treat unrealized profit when parent sells to subsidiary and how to do so when the reverse happens, when the subsidiary sells to parent. There are two different issues and we need to look at them differently. Now, let us first of all look at the case where the parent is selling to the subsidiary. Now, like I said, before I even look at that, when you sell to a subsidiary or subsidiary sells to parent as a profit, this is the implication. We expect that by the time that we are consolidating, the subsidiary or the parent has sold the goods that they received. Okay, let's say parent sold to subsidiary, and by the time of consolidation, the subsidiary has sold all to external people or customers, and therefore the profit on those inventories has been fully realized. So let's deal with a situation where parent sells to subsidiary. I will also come back to a situation where subsidiary sells to parent. So when parent sells to subsidiary, let's say P sold goods worth maybe 2,000 to S for $2,500. Now, this is the meaning. It means that the goods, the cost price of the goods, $2,000, but they were sold for $2,500, meaning that there is a $500 profit on the goods that is being sold from the parent to the subsidiary. Another way they could have put it is that they will not give you this amount, but they will give you a percentage markup or margin. And they will tell you that P sells to S 2,000 goods at maybe 10% margin, or 25% margin, or 25% markup, or 10% markup. Now, whatever the situation may be, remember first of all that there is a difference between markup and margin. If you have doubts, I have a video on that, converting markup to margin and margin to markup. The title is Markups and Margins. You can go back. It's just about 15 minutes video or 10 minutes video. Just go and do a quick recap, because in the consolidated statement of financial position, you need to understand how to convert markup to margin and margin to markups, especially in the area of unrealized profits. Now, P can sell to the subsidiary at a margin or at a markup. Now, if it is a margin, margins are applied on the selling price or on the sales. Markups are applied on the cost. And so you need to know how to change each of them. Now, if this is the cost and this is the selling price, then we are trying to say there is a profit element of 500 per the example I have put on the board. Now, if at the date of consolidation, you are told that any portion of this stock remains in stock. For example, if they tell you that as at the date of consolidation, half of these goods remains unsold. Half remains unsold. So the expectation is that if all these goods have been sold, then there will be no unrealized profit, because we are not supposed to make profit from each other as a group, because we are a single entity. But we are expected to make profit from third-party customers. And therefore, if I sold to the subsidiary and the subsidiary has successfully sold all the goods to third parties, then the group has realized all the profit. And so when we are consolidating, we have no issue of unrealized profit. But in a situation where part of the goods remains in stock, like in this case where they tell you half remains unsold. Now, in that case, what we are trying to see is that we want to just look for the unrealized profit portion. Okay, and so half means that only 1,000 is sold. If you look at the profit element, the profit element is $500. And so half being unsold means that half of the profit remains unrealized. That is the meaning. So if you divide this by 2, you have $250. So what we are trying to say is that in this very scenario, if half remains unsold, then $250 remains unrealized. And that is the unrealized profit. Now, take note that no matter how sophisticated or cumbersome the question may look like, your main objective is to calculate for the unrealized profits. So they may twist and turn the language in whatever way that they want to do. But your main objective is that look for the unrealized profit. After looking for the unrealized profit, all these figures will not matter to you again. You're only going to deal with the unrealized profit. So after going through all that, now it is only these 250 that will matter to us. They could have used all other forms to confuse us, but the main objective is to find any unrealized profit. If there are no unrealized profit, you just skip that additional information and you move on. So once you have unrealized profit of 250, you now know how to treat the unrealized profit. Now, how are you going to treat this unrealized profit in the consolidated statement of financial position? Please take note that I said earlier, now we are still dealing with the situation where parent sells to subsidiary. The working will be the same, whether subsidiary is selling to parent or parent to subsidiary, the workings are the same. But the treatment will not be the same. So having understood the workings, let us look at the treatment in a case where parent is selling to subsidiary. So that when we have understood, I'll turn it and look at the treatment in a case where it was a subsidiary that sold to the parent. So now, parent sold to subsidiary, we've gotten unrealized profit of 250. How are you going to treat that? Now, when the parent sold to the subsidiary, they made profit of 500. But this 250 remains unrealized. So what it means is that that profit should be eliminated from the retained earnings of the parent, because the profit is on the inventory. You have only inflated your inventory, because remember that when you sell to the subsidiary will record that full amount of as part of its inventory. As part of its inventory. So the inventory of the subsidiary that you see on the financial statement includes that unrealized profit of 250. That's the meaning. They will not see it as profit. You have sold to them. To them, it is cost. To you, it is your selling price. To them, it is the cost price. So they will record the full cost price as the value of inventory. Okay? But to you, you know there is a profit element on it. You made sales. And therefore, when you are consolidating, you should not overstate the inventory of the group, because we are seeing ourselves as a single entity. And if we are seeing ourselves as a single entity, then the inventory of the group should not be inflated by the unrealized profit, which is inside that of the subsidiary. So we have to reduce the inventory value of the subsidiary or of the group by that unrealized profit of 250. We are only deceiving ourselves, because we are a single entity. We have not made any profit. We only make profit when we sell to external customers. And therefore, this 250 must be reduced from the value of inventory. At the same time, this 250 is not profit we have made, but it is inside the retained earnings. It is inclusive in the retained earnings of the parent in this case. So the retained earnings or the income surplus balance of the parent must also be reduced by this 250. And so when you are doing your adjustment, you are going to say the double entry is going to be like you debit your income surplus or your retained earnings by 250, and then you credit your inventories. That is in the consolidated statement of financial position by the same 250. This is the treatment. When a parent sells to a company, you reduce your income surplus balance by 250 and you reduce your inventories by 250. This is how to treat unrealized profit. Like I told you, we only need the unrealized profit to eliminate from both the retained earnings and then from the inventories value. And please, this retained earnings, when you are debiting retained earnings, it means you are subtracting. That is the meaning. It has a credit balance. Inventories have a debit balance. It's an asset. So credits means you are reducing. So both of them is being reduced. Now remember that you are going to prepare what I call the big four. You are going to prepare the group income surplus or the consolidated retained earnings. And so in your working for consolidated retained earnings, that is where you are going to reduce these 250 from the income surplus. So it will be part of your workings of the consolidated income surplus. And therefore, when you get to the statement of financial position, consolidated, and you get to inventories, okay, it's going to be that of the parent plus the subsidiary minus the 250, which is the unrealized profit. If there was any goods in transit, it will be added, whatever, like I did earlier. So it could be a long bracket for inventories. But if there is any unrealized profit, please, it will be subtracted. If there is any stock in transit, it will be added. That is the adjustment to be done on inventories. But the income surplus will be reduced from the calculation of the consolidated retained earnings or the group income surplus. So that at the end of it, or the consolidated statement of financial position will still agree. This is the treatment when a parent sells to a subsidiary. Debit the group income surplus and then you credit the inventories of the group. All right. Now, let us also look at the situation where the subsidiary rather sells to the parent. So, subsidiary sells to parent. The treatment is going to be different. Watch how it's going to be. Now, in a case where the parent sells to the subsidiary, remember that if the parent sells to the subsidiary, whatever unrealized profit or whatever profit element on the sale is enjoyed by the parent only. So that 250 is enjoyed by the parent. And so that is why we did just one quick reversal. Now, in a case where a subsidiary is selling to the parent, whatever profit element on the sale is not only enjoyed by the subsidiary, there is a non-controlling interest that is also likely to enjoy. Because in the case of a subsidiary, the parent may not be having 100% control. And whatever control that they have, there is a percentage left for non-controlling interest. And so the non-controlling interest will have a share of that profit. And so in this case, the group structure will matter. So if you have a group where the structure is, let's say, 80% to 20%, for example, then in a case where your provision for unrealized profit is 250, okay, or let's say your unrealized profit, sorry, no provision, where your unrealized profit is $250, then you have to first of all look at the unrealized profit and see that 80% of this unrealized profit will be enjoyed by the group, which is for the subsidiary, and then 20% for NCI. Okay, so the group enjoys 80% and 20%. So in that case, it's going to be $200 against $50. Now, what we are trying to say is that that profit that was not realized, NCI will have a share in that profit. And so when you are reversing, this time it will affect the calculation of NCI as well. Okay, so in this case, this is how it's going to be. When you are reversing something like this, if the unrealized profit is 250, but it is not the parent that sold, but in this case, the subsidiary rather sold to the parent, then you are going to debit your group income surplus. Okay, in this case, that's the group income surplus with 200, meaning that all the 250 will not be subtracted from the group income surplus account. It will be 200. And then you also debit the non-controlling interest, which is the NCI, with 50. So it means that the 250 which should have been debited to the group or the consolidated retained earnings, that 250 has been split. 80% of it will be charged to the group income surplus account. 20%, which is 50 CD, will be charged to non-controlling interest. And then inventory remains the same. You credit inventories with a total amount of 250 so that it will now agree. And so take note that you don't just have to say that it's always the case with the first scenario. When it is the parent, you need to be sure about who is selling from the question you are solving. If it is the parent that sold to the subsidiary, then in that case, it is all for the group. But if it is a subsidiary that is selling to the parent, then that portion of the unrealized profit relates to the non-controlling interest. And so when you are doing a reversal of the unrealized profit, you don't reverse all from the group income surplus. You reverse the percentage holding of the unrealized profit. So you find the percentage, 80% of the unrealized profit, which in this case will be 200 out of the consolidated retained earnings, and then 50 goes out. Debit means you are reducing because both of them have credit balances, and a credit means you are reducing the inventories. And so this is how it's going to be. You debit the income surplus of the group with 200, you debit the non-controlling interest with 50, and then you credit inventories with 250. And so when you are doing your calculation for the group income surplus, you are only going to reduce 200. And then when you get to the working of NCI, you subtract these 50 as well before you prepare your consolidated statement of financial position. And when you get to inventories, it is that of the parent plus the subsidiary minus any unrealized profit on the inventory. That is how to treat it in a case where the subsidiary sells to the parent. But if the parent sold to the subsidiary, you watched how that also was. And I think you shouldn't be confused again after today. All right. So that is it with the intra-group trading for unrealized profits. We have looked at both scenarios where the parent is selling to the subsidiary, and we have also looked at it when the subsidiary is selling to the parent. So the final thing under the intra-group balances that we are going to look at is the transfer of non-current assets before we look at the fair value adjustment, and then we'll be done. Okay, so we are looking at the transfer of non-current assets. How to deal with that? Transfer of non-current assets between members of the group or companies in the same group. Now, when I say transfer of non-current assets, what I actually mean in this, guys, is the sale of non-current assets between themselves. Now, a parent can sell non-current assets to a company, a subsidiary company, and a subsidiary company can also sell. So just as we looked at it in the case of the unrealized profits, over here, we also have issue of unrealized profit. And we are going to look at the treatment in both cases, where the parent is rather transferring the non-current asset, and we'll also look at the treatment when the subsidiary rather transfers to a parent. Now, please take note of something. Anytime there is a transfer of non-current assets, two issues arise. The first one is that there could be possible profits. Possible profits could be made on the transfer. So if the current asset net book value or the current amount in the books of the parent is, let's say, $1,000, they can transfer it to the subsidiary for maybe $1,500 and take the money. So it means that they have transferred it as a profit of $500. So there could be possible profit. One other dangerous thing that happens the moment there is a profit is that the buying company will also depreciate the asset and depreciate the profit. That is the risk. So these are two issues that arise. Anytime there is a transfer at a profit, the possible profits will come for one company. The buying company will also depreciate because the asset cost or the net book value of the asset may be $1,000. If you transfer to one party at 1,500, in your books, you will add this 500 to your retained earnings, maybe as your profit on disposal of assets. But to the buying company, they will see this as the cost of the asset. And so they are going to depreciate the asset, of course. And in depreciation, they are going to depreciate their cost to them. To you, this was the net book value. To them, this is the cost. So if the asset has a useful life of, let's say, 10 years, then it means that every year they are going to have a depreciation charge of 1,500 over 10, which is going to be $150. Now, this $150 is how much they are going to charge every year for depreciation. Meanwhile, this 1,500 includes a profit element too. If it was a third-party customer we sold to, we don't have a problem. But because we sold to a member of the group and we are consolidating as a single entity, we cannot depreciate profit. And it's going to be a big challenge. And so what we are going to say is that the actual net book value of the asset is 1,000. And we transferred as a profit. So if they had depreciated, you are going to find the value of depreciation. If they are depreciated at the original net book value, it would have been $100, meaning that there is an excess depreciation of 50. This excess depreciation should not stand, and we are going to learn how to treat that. First of all, we are going to treat the unrealized profits of 500, the reversal of it, and then we are also going to reverse any excess depreciation. So there will be two reversals in this case whenever there is a transfer of non-current assets. First of all, we are going to reverse the 500, which is the profit element on the transfer. That will be done. And then afterwards, we are going to reverse the excess depreciation. Anytime there is an excess depreciation, we reverse that as well. And once both are completed, then we can get a correct group account using the single entity concept. And so that is the implication of the transfer of non-current assets. Remember that I have said there could be a possible unrealized profit, and the unrealized profits will cause the buying company to depreciate the profit as well. The profit of 500 is being depreciated. And so those extra ones, we call it excess depreciation, will be reversed just as we reverse the unrealized profits. Remember that if you are reversing unrealized profit, you are debiting the income surplus. But if you are reversing depreciation, you are crediting the income surplus because you are adding it back. So just take note. The one will be going out, the excess depreciation will be added to your income surplus and then maybe added back to the value of the asset. That is what we are trying to say. Now, we are not done with this. Having understood the dynamics and how to calculate this, what we need to understand is that there is a different case of treatment when the parents transfers to the subsidiary. And when the subsidiary also transfers to the parent, it will be different. Of course, if the parent transfers to the subsidiary, there will be no issue of non-controlling interest. But when the subsidiary transfers to the parent, we are going to have issues of non-controlling interest. And so I'm going to clean this, and I'm going to show you how to treat them in each case where a parent is selling to a subsidiary and where a subsidiary is selling to a parent. All right. Okay, so let's look at the treatment in a case where parent transfers to subsidiary. So parent sells non-current assets to subsidiary. Remember that in this case, we have no issues with non-controlling interest. And so what we are going to do is that we are going to debit the income surplus, that is the group income surplus, and then we credit the non-current asset value with the unrealized profit. So in the case, in the scenario where I created, I said the asset net book value was 1,000, but it was sold for $1,500. So there was a 500 CD unrealized profit. So in this case, we are going to debit the income surplus with 500, credit the non-current asset value with 500. So what you are trying to say is that we are eliminating the unrealized profit, and then now listen. In this case, for transfer of non-current assets, most often than not, all the profit will be unrealized because it's not likely they will sell it. It's not inventories that they are going to sell. So mostly all of them are unrealized. So all the unrealized profit goes out of the group income surplus because the parent had already recognized that. And then we reduce the value of the inventory by the same 500 so that it will reset back to the 1,000. So when you are doing your account under non-current asset or PPE or whatever, you add that of the parent to the subsidiary, and then you subtract the unrealized profit of 500 before you bring your final figure on the consolidated statement of financial position. So parent sells to subsidiary, you debit income surplus, you credit non-current asset with the unrealized profits on the PPE. That's the meaning. So you use the unrealized profit. This is the first part of the treatment. You are not done yet. The second part is whether it has been depreciated or not. And if it is, then there should be another adjustment for excess depreciation. And let me show that to you as well. So when you are done with this, you are not done. Then you, after doing the adjustment, the next adjustment is look at the excess depreciation. So with the excess depreciation, you debit the non-current assets. In this case, it was 50. So you debit it with 50, and then you credit the group income surplus with another 50. Yes, with the excess depreciation. So what I mean with excess depreciation is that now this profit has already been depreciated, and so we need to reverse that depreciation because that 50 depreciation was not to go out from the value of the asset. So you, by debiting non-current asset, you are adding 50 back to PPE, and by crediting income surplus, you are adding 50 back to the profit. So when you are dealing with the PPE or the non-current asset in the consolidated statement of financial position, you bring that of the parent plus the subsidiary, then minus 500 unrealized profit plus 50 excess depreciation. That is how it's going to be done. I know I'm blowing your mind. But I'm sure it should be very understandable, even though it's bulky, it's plenty. But if you take it a step at a time, as I'm trying to make it look like, I'm sure that your understanding will be very much enlightened, and you'll be fine. And it means that when you are dealing with the excess depreciation with the group accounts, so when you get to the group income surplus or the consolidated retained earnings, you subtract 500 and then you add 50. That is the meaning. So you are getting more and more adjustments on your consolidated statement of financial position. When I'm done with this intra-group adjustment, in the next video, I'm going to solve a question, a complete question, which involves all that we have done from the beginning till intra-group adjustment. That will be the part 6. And then I'll be done with a consolidated statement of financial position. Then we will look at consolidated statement of profit or loss. When we are done with those principles as well, then we'll combine. I'll look at accounting for investments in associates and joint ventures, so that we will look at a situation where we have three statements of financial positions. One will be an associate, and then we'll look at how to deal with that as well before we finally done. Like I told you, this is a full series, but we are gradually bringing the part of the statement of financial position to an end. Afterwards, we'll look at the profit or loss and the changes in equity, and then we can look at accounting for associates and then joint ventures as part of consolidation, and then we'll be done with group accounts. Maybe that is for the basics. And then in the near future, we are also going to look at the mixed group. Sorry, we are not done completely. When we are done, we'll be done with the basic principles, and we'll look at the advanced consolidation techniques, where we are going to look at the mixed group and then the foreign subsidiaries as well. And so we should be also mindful of that. Later, we'll look at the group cash flows as well. Okay. Now that we have been able to look at the situation where parent sells to subsidiary, let us look at the transfer when it is from a subsidiary to a parent, how NCI will be involved in this analysis. So let us look at when subsidiary sells a non-current asset to the parent. All right, so we say subsidiary sells to parent. Like I told you earlier, anytime it is coming from the side of the subsidiary, remember that the group does not have 100% shares at all times. So there could be a possibility that NCI or non-controlling interest could have a share in the profits. And therefore, we need to show the reversals, including that of the non-controlling interest. So let us look at the treatment for the same 500 unrealized profit and the 50 excess depreciation in a case where it was a subsidiary that sold to the parent. In that case, just as we did, we are going to debit the group income surplus. But in this case, it's not going to be with the whole 500, because we need to apportion that of the group to it, and then we apportion that of NCI. So the unrealized profit of 500, if the percentage is, like I said, 80-20, then it means that 80% of 500 will be 400. So we'll debit income surplus with 500, and then we debit the non-controlling interest, NCI, with 100, so that we can credit the non-current assets, which is the PPE, with 500. So this is how it's going to be when it is the subsidiary that is selling to the parent. The whole 500 will not be taken out of the income surplus. A portion will be apportioned to the non-controlling interest, but the full unrealized profit will be taken from the non-current asset. And then when it comes to the depreciation adjustment, we are going to debit the non-current assets with a depreciation of 50, and then we credit the group income surplus and also credit non-controlling interest. So in this case, we are going to credit the group income surplus with 40, which is the percentage apportionment, and then NCI with 10. That is a percentage apportionment. And so you see that the entries are not different. They are the same. The only difference is that when a subsidiary is selling to a parent, NCI comes in. When a parent is selling to a subsidiary, NCI has no business. That is the meaning. So whenever you meet a question, don't be too quick to think it's always the same treatment. Be sure and analyze to know who is selling to who, so that you will know how to make the adjustment. Because all these things that I'm using debit and credit to show, whenever there is a debit for these items, it's a reduction. So when you are doing your workings, we will show in the next question that I'm going to solve that we are going to reduce these ones from the group income surplus, and then 100 from the non-controlling interest. Now, it is also important to add that if you forget to do this and you assign all the 500 to income surplus, assign all the 50 to the income surplus, please, your statement of financial position will still balance with the same correct amount, but you'll be wrong because the individual figures in there will not be the same. So don't think because it has balance, your treatment is also right. Please and please again, take note. Just like the intra-group debts, the payables and receivables, if it is cash in transit and you treat it as goods in transit, your balance will still agree, but you are wrong. So take note, the effect is the same. All right, so this is how to deal with the transfer of non-current assets. I am sure that we are okay with the intra-group balances. The final thing for me to talk about is fair value adjustment. And that is what I'm going to conclude with. All right. Now, with the fair value adjustment, I'm not going to waste much time talking about that because we've learned a lot about it from our PPE, IAS 16, and other non-current assets standards. Now, we know fair value, okay? The value at which an asset will be exchanged between knowledgeable, willing parties in an arm's length transaction. And we also know from PPE that IAS 16 that whenever a company is treating non-current assets, they either go by the cost model or the revaluation model. And so measurement subsequent to initial recognition could be the revaluation model. And that is where the fair value model comes in. Now, and we also know that anytime an asset is revalued upwards or downwards, the financial statements must reflect the new fair value. So if you have in your asset a PPE valued at $4,000, and then you are told it has been revalued upward to $6,000. Now, whatever happened, this is the original net book value, and this is the new fair value. Now, you see that there is an upward revaluation, and the difference is $2,000. This $2,000 is a revaluation surplus that has been created for you. And so what we are going to say is that now, when you are preparing your consolidated statement of financial position, the additional information will mention to you that the asset was 4,000, has been revalued up to 6,000. So you need to reflect that in your consolidation. That is what we mean by reflecting fair values or fair value adjustment. And so what we are trying to say is that these 2,000 will be created as a revaluation surplus down there, because remember that the accounting equation is always true. Asset equals to equity plus liabilities. So if the asset is going up by 2,000, it was already 4,000, it has gone up by 2,000, then one of these must also go up. Other than that, the accounting equation will not agree. And so definitely the equity must go up by 2,000 in the name of revaluation surplus. And so anytime there is an upward revaluation, you just show that it is a revaluation surplus. Now, if it is a first time revaluation and it is a downward revaluation, according to IAS 16, we don't create a revaluation loss. We rather charge it out of a group income surplus. And so if, for example, this revaluation was not $6,000, but it was $3,500, then what has happened is that for the first time of revaluation, it is a downward revaluation. And so the difference of 500 cannot be called a revaluation loss from the beginning, except there was originally a surplus there. That is where we can go and subtract. But if it's a first time revaluation and it results in a loss, this loss must be charged to income surplus. And so when you are preparing your consolidated statement of financial position, the new figure of 3,005 will be shown as PPE, not the 4,000. That is the meaning of reflecting fair values. And then this 500 will be reduced from your group income surplus. And so what you are going to do is that you are going to debit with a reduction. You are going to debit the income surplus with a 500, and then you are going to credit the PPE with 500. That is why we are not showing the 4,000 again, but we are showing 3,500 because we have reduced it by 500. But if for the first time there was an upward revaluation of 2,000 like I illustrated, then of course you are going to rather debit PPE with 2,000, and then you are going to credit. This time it's not going to be the income surplus. You're rather going to create a revaluation surplus, and then that will be 2,000. If you have doubts, you can still go back and watch the video on IAS 16 that I have uploaded, and then you will revise. Now, one of the most important things that I want you to know is that the fair value adjustment will affect the net asset list. And that means it will affect the goodwill calculation as well, especially when it was made at the time of acquisition and you didn't know about that. Okay? And so let's assume that in a financial statement, PPE, like I said, is 4,000. Then you are told in additional information that at the date of acquisition, one of the property had a fair value in 1,000 excess fair value. That was not reported. So now, this 1,000 is an excess. In other words, it's an upward revaluation. And it was done at the date of acquisition. Now, take note of the date of revaluation. It could be done at the date of acquisition or at the date of reporting. If it is at the date of reporting, it will not affect the net asset list on the acquisition date. So you are going to make a net asset list for the subsidiary at reporting date and then at acquisition date. So normally you have your share capital, you have your income surplus, whatever other surplus that you have. And then you have the fair value adjustment or revaluation surplus. Now, this fair value adjustment, if it was done at the beginning or at the acquisition date, then this 1,000 will be here and there at the same time. If it was done at the reporting date, it will be only at the reporting date. That is how to do your net asset list with a fair value adjustment. Now, if it was done at the reporting date, at the acquisition date, it will be here and there at the same time. If it was done at the reporting, it will be there alone. Because at acquisition date doesn't mean that it is not there at reporting date. So it will be both there. The only difference is that by that time it would have been depreciated. So you need to also make depreciation adjustment. So if the depreciation is 100 that has gone off, then you need to reduce 100 from reporting date. Let me clarify this. If your upward revaluation was 1,000, then it will be there at both at the acquisition and the reporting date. But if it was there at the opening, then it means that the reporting date would have been depreciated. So you subtract the depreciation. But in the situation where it was not there at the beginning, then it means that there will be no depreciation adjustment because we are just finding the fair value and we are not going to depreciate it because we are doing it exactly on the date of reporting. So this is how to go by fair value adjustment. I don't know how understanding it was to you, but if you understand the property, plant and equipment, IAS 16, I'm sure you would understand this as well. And so I'm going to end it here, but in the next video, I'm going to solve a question that involves all these things, including the fair value adjustment. And then I think when it's practical, understanding will be better. And so that is what we are going to do. So thank you so much for watching. In fact, if this is your first time, I want you to subscribe to this channel, share this video. A lot of you come and watch without subscribing. Please subscribe. Invite your friends to the channel if you have been blessed or helped. And then let us grow together and be successful together. We'll meet again very soon for the part 6 of this video. Until we meet again, it is bye for now.